Good morning. It's Tuesday, May 3rd, 2016. This is Vance Williams. So let's start a little bit with the fundamentals. I wasn't here Thursday, so we left off talking on last Wednesday. You can always go back and look at those videos. But following FOMC last week, there was no new information at all about a rate hike in the U.S. anytime soon, and this put more pressure on the U.S. dollar. And this is what I said you should expect, only because the name of the game for central bankers is stability. Uh, what is more dangerous to the global economy than anything else is instability. And this is due to the house of cards, otherwise known as derivatives, which is how the truly rich and powerful print money. A lot of people complain about how they pay themselves big salaries, but what most people don't realize is they're actually printing the money. They don't have to earn it. So the masses haven't quite caught up with that idea. But anyway, that whole operation, which is in the hundreds of trillions of dollars, it's like people juggling, I don't know, something fragile in the air. If there's too much instability, they could kind of lose sight of where those balls are. So that's the main thing. So that's how I kind of know with some confidence what's likely to happen. I'm going to show you a trade you could have taken in just a moment, but why I didn't. Okay, so at some point with respect to the central bankers, we'll begin to see them want to allow the US dollar to move back the other way. But that's not where we're at now. Right now, we're looking at probably some profit taking. All right, so let's go to price. Before I go any further, I just want to pause and tell you, I mean, you may not have ever heard me before. I don't have anything for sale. I do these sessions for the traders that I've worked with off and on for about, well, this is my 12th year. But you will find before I retired a year ago, you'll find I put a book here that has all of my 11 years of Forex trading and training experience in one book. I just kind of wanted to leave that behind for you guys. So I would say that's probably the most valuable Forex trading book you're ever going to get. You can get it right here, and you'll notice when you click on it, it doesn't ask for an email or anything. And the reason why is because I have nothing for sale. All right, so read that book if you're serious, but I gotta warn you before you read it, it's gonna be more difficult than maybe you hoped for. And I mean, it shows you how to do it, but it's gonna take you a while. So only read it if you're serious, because if you're not serious, you might find the book a little disappointing, going, is this hard? Not that it's hard, it just takes time and a lot of practice. All right, so as you can see, we came through a line. Now these lines, what are these lines? These lines are just me marking where buyers and sellers resolved at 50-50 along the way. And then what I look for, you'll see me doing this, and this is really an advanced skill, even though it sounds simple. What I look for is a change, like there's a change right here. You can see, they work at it and it finally closes right there. And then you see another 50-50 level right here. And then you notice a change where it closes below, and that's where I said you could basically look for a trade. I'll come back to that in a moment. Let's go to the euro. I don't have a lot here on the euro. It's between the euro and the dollar. They're kind of not kind of, they are the main reserve currency pair, and that just means that's where people with the big money have their money stored, and they're kind of trying to prevent $1 billion from turning into $800 million over time. And so you do see a little bit of a change, comes below, it hits, and you can see it. It's always relevant. You'll see this time and time again. But you'll see it come back here and drop. Now this is, we want to notice that this is the 30-minute, and the balance of money is up. So the majority of the money is up. So if you were to take advantage of something like this, where you saw a little change, you could probably be in a higher probability situation for a trade, but you'd be going against the direction of the elephant, so to speak, or the train or the bus, whichever you like. All right, so the pound looks a little better because it's come way back. It's had a couple of changes. It's right at the trend turning point right here. So you can see it came down. Let's zoom in. This is a 30-minute. You see it closed under. Then it pushes all the way to the bottom of this level. Again, this is where buyers and sellers reconciled at 50-50 in a climbing manner. And this is where it says, hey, they're no longer able to climb. They held on right here, as you can see, held it in after 30 minutes, and then they closed below. So this is where I would have looked for a trade. Now let's go down to the 5 minute. And you can see how it held. It got up there a little bit, then it held. I saw it right here. I thought this is probably a nice spot to pick off about 10 pips. And you can see already it's moved down 25. Now, why didn't I do that? I wouldn't do that because it was counter trade. I mean, I'll do it sometimes, but not very often. I mean, it just adds risk to it. You know, everything you see is in place. It's all pointing to movement down, but the balance of money is to the top side. I just don't like that. It's an added factor. Just call it a variable that increases your risk. And you've got to look at these variables like that. It's like any situation in life that involves risk and provokes emotion. Let's say someone is facing a life and death situation, and you are somehow, maybe you just think you're involved in the decision, and this is causing you fear and emotion and what have you. The key for a trader in that situation, let's say you are the advocate for the person, you know, your job would be to talk to all doctors, gather all the information, and move towards the highest probability choice. That's your job as an advocate. And, you know, and that's, of course, given the desire of the patient is to live, right? And that's why an advocate would step in. The person cannot advocate for themselves. And the reason why I'm giving you that analogy is because that's really what trading is like. You're like an advocate. You can't be emotionally involved. You need to get the best information you can, decide what the highest probability course of action would be. And then, of course, with respect to currency trading, you also have your limitations. For example, you'll see in my book, if the probability is dropping below, 70, 68%, then you know there's a point in time where you just have to not trade at all, because there's a direct correlation between your winning percentage and the number of losses you'll experience during a drawdown. Now, this is probably over the head of most people listening, but basically, the less you win, in terms of, let's say you win 70% of your trades, you're likely to have between 4 and 6 losses during a drawdown, which is when something changes in the market that you can't anticipate. And so now I want you to notice something. When winning percentage drops down to 65%, your drawdown potential increases up to 10. Now, the reason why this is really important to know is because the way that our minds work in this world, put it in a simple way, psychologically, we're kind of like 1 strike, 2 strike, 3 strikes, you're out. So in other words, if we have a decision-making process that causes us pain, so, lost, let's say we missed a trade, we lost, it hurt, made us feel bad, but hey, it's just 1 loss. Vance says, that's normal. So you go ahead and you use your trading plan, you enter a trade again, and you lose again. So not only did you lose, but did you experience pain, but the subsequent loss causes even more pain, and that's the way this works. So most people, I would say most new people can only endure 2 losses before they say, you know what, there's something about this method that doesn't work. People with good trading can endure 3 or 4. Having learned that this is natural, following your trading plan and not letting those emotions skew the logic. But pretty much nobody can, except for highly trained people, can endure more than 6 losses. So where I was going with all that is that you have your limitations. So your limitations, especially if you're new, first couple of years, is probably 70% winning ratio. Because if it's lower than that, the number of losses that you'll incur in a drawdown will disable you psychologically. And the way you'll see that, if you've been doing this for a while, is every time you lose, 2, 3, or 4 trades, you change your trading style. And this is just short-sighted, right? So that's a hurdle that you have to cross on your journey to become a great trader. So all that's in my book, guys. It's all in there. So This will make a lot more sense to you if you read the book. Now, one of our guys, G, asked me to talk about trailing stops. I believe that's in my book as well, but I'll talk about my experience first. My experience is, we hit a point in time in 2008 where it was all bets off. The global economy, the whole entire financial system was in question. We went through many years where we did not know if price was going to go up or down, if the euro was going to go away, if Greece was going to default, whatever. We were like that for years. So there was no long-term trend. It was all about having the patient on life support, the banks on life support. And so for many years, there was no long-term future for anybody when it came to the financial system. And we had to learn to make decisions that were in a much smaller window of time. Now, today, a couple of years, we've crawled out of that. We've got a little bit more free movement. We've got a lot more stability, but we're still trapped in what some would call the liquidity trap, which Japan kind of started back in the 90s. And basically, that's a trap where you're stuck in a situation where you can't raise interest rates to enable the free market to thrive. And so you're stuck in a situation where the banks continually have access to cheap money. They do not need the public at large. They cycle that money through. A lot of it's gone into stocks and what have you, but we can't get out of this cycle. When's the last time your bank offered you a toaster in order to open up a checking account? They don't care if you open up a checking account. For the most part, they don't need your money. So there's that going on. Let's see, where was I going with all that? Trailing stops. So I think the only way you can use trailing stops right now is you have to monitor these trends. And so remember, we're talking about stability. So let's go up to the pound, and we see this trend down followed by a correction, another trend down followed by a move up. Then we got sideways for a long time. So when this is sideways, let's say, for example, you were buying down here, you could use a trailing stop and kind of gauge that there might be more potential to this range area right here, and then same thing going down to the bottom. You don't want to go all the way to the bottom. So that's a movement of about 214 pips. So that's a possibility. Now let's just talk about trailing stops in general. I mean, you can try this out for yourself, but here's what you're probably going to find. Here's what really happens. So you get into a situation where maybe you get a trailing stop on all the contracts. Maybe you close out half your contracts and you leave the other half on, or a third on, or whatever, trying to get more, right? The idea is you're trying to get more. And the problem with that is the probability of you getting more is pretty much diminished because of the lack of information. Now stay with me here. All right, so let's say you close half your contracts, take a profit, and then you try to let the others ride. Now, what you're going to find over time is, and by the way, had you closed the second half of contracts, you would have put money in the bank. Now, so you've let that second half of the contracts, you're letting that ride, and you're going to find that maybe 50% of the time, maybe less, you actually get more. So what you find out over time, I think what you're going to find, until you get a really good sense, you got good information on longer term trends, what you're going to find is you were probably better off just taking the profit that you had on that second group of contracts, right? So because a lot of traders, what they're going to do is when they take the profits on the first half, they're going to move their stop to break even for the second half. They end up breaking even on that and not making a profit. And so basically what I'm saying is you'll probably find that you make more money if you just go ahead and take the profits on all your contracts right now. But that's up to you. But anyway, that's my thoughts on trailing stops. Let's see what else we got. That's about it. So I would, you'll see me doing this. I'll drop down to the 5 minute. I'll watch it, here it sneaks in, sneaks out. Probably the second time it closes under. In this case, if I had any doubts, I would probably go in about right here. Go for something small. Remember that it doesn't matter if you get 10 pips or 100 pips. Now, it doesn't matter if you're going for 6 because, as you'll read in my book, there's a limit to how small your target can be, and this accounts for usable margin and market noise, all of these types of things. So, but it doesn't really matter whether you're targeting 10 pips or 100 pips. If you're risking $1 to make $2, or risking $100 to make $100, whether you get 10 pips or you get 100 pips, you make the same amount of money. So that's all in my book too. And you just really got to understand what's really important about making profit. I think that's about it, guys. Again, go to forexartofwar.com if you want my book. That's right here, forexartofwar.com. Just click in this yellow section. No email, no anything. You get my book. And write to me, VanceWilliams@myself.com, VanceWilliams@myself.com. If you have a question, you have a topic you would like me to cover during this session. You guys have a great one. Oh, and I'll be back tomorrow at 9:30 a.m. Eastern.